Thank you for this opportunity, and thank you for your support in the last year. So, as David said, the 2022 vision, it's a bit of a play on the 2020 vision, what lies ahead in the year for us. So just a quick review of the market, and some of the earlier speakers have covered it, so I'm not going to do it in detail. I think the biggest surprise has been the surprising rise in inflation, especially in the US. Now, initially, it was seen as transitory, but it kept on surging, and I think the Fed has now admitted it's not transitory. Maybe it's a bit more sticky, and they've also indicated that they're going to start tightening a bit earlier. But I mean, saying that, the last quarter of last year saw a very strong run in markets continuing. And it was driven by the easy monitoring conditions. So strong commodity prices, and we've seen new highs in many equity markets. In SA, we've seen a fantastic recovery since COVID. It has however, been quite a narrow performance. And there's still areas that we find value, so we think there could be a bit more to come. If we look at SA bonds, it's actually just tracked sideways, maybe sold off slightly, so still offering a very high nominal yields. So as David said, just quickly looking at the performance, we had a very strong last quarter, which translated into a strong year. So we're very pleased with the recovery in the fund. And even if you look at the longer term numbers, 3 years, 5 years, and since inception, we have managed to outperform the category average by quite a margin. Just looking at where that contributions come from, and I'm going to speak mostly to the 12-month performance. Royal Bafokeng, our biggest contributor. That's a share that you know that we've spoken about often. We've always said it's got a high quality, it's a high quality asset, and it's a very good takeover target. And we then saw the bidding war between Implats and Northam translating into quite a strong performance contribution to the fund. British American Tobacco, very pleasing to see our second biggest contributor. That has been a share that's lagged, that's been a drag on performance for a long time. And we started seeing a strong recovery towards the end of last year, and it's had a fantastic start to this year. So that should continue. And despite this run, we still think it's offering decent value at current levels. Very pleasing to see that our investment notes, specifically our note that we had on the Eurostoxx index, also contributed nicely. We've still got decent exposure to that, and I will refer to that a bit later. The Abax Global Equity Fund, managed by us, we had about a 5% average position, and that was our fourth biggest contributor. So the stock picking in the Abax Global Equity Fund coming through strongly, and also the currency diversification benefit that we got there. And then a small holding, only a 0.8% average holding, but because of the strong run in commodity prices, and specifically in Merafe, one of our top 5 contributors to performance. If you look at our detractors, the top 5 contributed 11.8%, and what's pleasing to see that our top 5 detractors only detracted 2%, with the biggest one being Naspers at 1%. Now, if you take into account that we've on average had over 5% position in Naspers, the detractions should have been a bit higher, but that's where the hedging that we use on our bigger positions really came in nicely and supported. One of our other hedges actually was a cost, the S&P hedge, where we paid for a put, and into a strong market that all the money that we paid for that put was actually cost to the fund. So what does the market look like for next year? I think this record high US inflation is going to have an impact on markets. So we're going to see globally synchronized interest rate increases, with the Fed signaling that they're going to start the tightening earlier, and the market already looking for about 4 interest rate increases, and we've even heard that some commentators are looking for 7 interest rate increases. That will have an impact on growth, so we will probably see US real growth slowing as the interest rate increases and as real rates increase, which is not great for US bonds. Market volatility has been very subdued for the last 20 months. And it will probably increase as investors digest this rising interest rate cycle. So into a rising interest rate cycle, you also don't want to have too many long duration assets, because the discount rate that you use to discount those future growth and future cash flows increases. So your present value reduces. And we've seen a bit of that already in the fourth quarter and the start of this year, where your tech shares have come under pressure. We've also seen value outperforming growth more recently. So I'm still a bit nervous for those long duration assets. Now, what assets are like that in South Africa? One can argue that Naspers is also a long duration asset because of its exposure to Tencent and its IT and internet exposure to the companies that they own. But we've already seen Tencent selling off a lot. So that happened even before this tech rout that we saw. We think in South Africa, there are still equities offering decent value. We think there could be a search for yield, which could crowd investors out of global markets into SA and emerging markets. And normally, a rising interest rate environment is not great for bonds. So, I mean, we're quite negative on global bonds. But in the SA case, we've still got a very high real rate on our bonds. And we think even if we see increasing interest rates, you could see the bond yield curve flatten. And that even if it doesn't, you get a very good running yield. So we still see a lot of value in bonds. So just looking at how the fund's positioned, and I've contrasted it to what it was last quarter when we spoke. Our equities have increased from 50 to 54. That's mostly due to the strong performance that we've seen in the equity market. That's increased that weighting. And from a high weighting in bonds at the end of September, we've increased that bond exposure further. As I said, we see quite a lot of value there. We have taken profits on some of our property holdings. Our convertible exposure is still relatively low, and you'll see we're running at very low cash levels, both globally and locally, as we see more value in equities and bonds. Our offshore equities are still at 5, and offshore bonds at 9. So if you look at the offshore exposure, it looks quite low. It looks like it's 14%. But within the SA equities, about 6% of that is our structured notes, which is mostly linked to offshore assets. So just looking at the key areas for consideration, as I said, we still see most of the SA assets quite attractive. SA bonds, we still think there's value in SA property, despite the strong rand that we've seen, and select SA equities. In a fair bucket, developed market equities, we think SA inflation is sort of, Laura has spoken about that, but sort of at reasonable levels. Emerging equities looking reasonably fair, and SA cash relative to global cash also fair. In the expensive bucket, developed market bonds, developed market credit, developed market cash, and US equity. So quite low exposure to those assets. Just looking at the SA bonds on the left, I've graphed the SA bonds in real terms, and you'll see that the real rate has come off a bit as inflation has increased. But you're still getting just under 5% real return. I mean, that's normally the type of risk premium that you would expect from equities, and here you're getting it in bonds. We still think there's room for that real rate to compress. I mean, if you buy a 14-year bond, you're almost locking in 10.6% per year for 14 years. That's at, say, the 2045 or 2035 bond. I mean, 2040 bond, it's 19 years of inflation plus 4 or 5. That's if we don't see an inflation shootout, which we don't expect. I mean, if you look at the left-hand side, that's the carry trade, the difference between our returns and what US investors can get. And that is what I spoke about earlier. I think that's a very high difference, and you could see global investors starting to find our yields attractive as they're forced to search alternative yield. And then lastly, just a few other considerations. We've seen margin buying and option trading, specifically in the US market, at record levels. There's a fund that JP Morgan Asset Management run. It's a $60 billion equity fund that's hedged equity. And every quarter, they hedge that portfolio. So the option open interest has increased significantly. And as volatility starts increasing, the trading to hedge all these options also become a lot higher. So I think volatility is set to increase. We have some hedges in place at both the market level and at the individual stock level. We've also got reasonably a defensive portfolio. So if you look at the risk appetite within the fund, I think that's gone down over the last year. So we've got cash alternatives in the portfolio, Imperial at about 4%, Long for Life at 0.5%. Both those companies are under offer for takeouts. We've also got the Eurostoxx basket at about 7%, which has got an embedded capital protection level. That being said, all these notes are substantially above the strike price, which means that on average it was 6.7% about a week ago. It's closer to 10% in the money on average. So a high probability that we're going to get paid out on those notes, and our weighted internal rate of return over 30%. So 3.5% of those notes, so almost half, expiring within the next 3 months. And then just the last point to note, you'll remember that Opportunity Fund owned quite a few Steinhoffs, and it looks like the Steinhoff claim will be settled. So those proceeds we would expect to receive in the next 3 or 4 months. So just a few concluding remarks. I think we are moving from a low declining easy monetary environment to an increasing interest rate environment. So because of that, expect more volatility as the market digests this new paradigm. US equity starting valuations high, so we worried especially about the long duration growth assets. We still see value in SA equities, and it could be a beneficiary of crowding out of developed markets because of valuation and also because of the search for yield, where our bonds will be a beneficiary. We find SA bonds attractive on both a nominal and real basis. So in conclusion, the Opportunity Fund, we think, has got a mix of capital protected instruments that offer decent yield. It's got a high weighting towards bonds, and exposure to attractively valued local businesses. I think with that, I'll open it up to questions. Thanks, Dave.
Thank you so much, Omri. And I could see you chuckling earlier when I had a slip of the tongue and said Tomri instead of Omri, but maybe there's a nickname in there somewhere. Apologies about that.
No worries.
I don't know if I've broken Doug's iPad. Yeah, hitting refresh on the question. So nothing has really come through from the audience on the last 15 minutes or so. So I'm going to take liberty to ask Omri a couple of my own questions. Maybe a bit unfair harping on one of the detractors of the fund, but yes. I do enjoy following a bit of politics, and the one that stuck out for me was really the Turkish lira bond that you own there. I was reading about Recep Erdogan, the president there, going on some bizarre sort of charge, and his argument was lowering interest rates should actually calm inflation, which is running, completely rampant, which is against everything we've learned in economics. So some interesting comments coming out of it there. I think also he's really started to cross that boundary of central bank independence. I don't even know if that exists anymore in Turkey. But like I said, maybe unfair given the fund has done incredibly well that I look at the single position, but it's just one that really interested me. Yes. What was the investment thesis going in? And does it still hold, or is it something maybe let's sit back and be patient on this position?
Yeah, it's a difficult one, Dave. It's a very small position. It was only a 0.2% position in the fund. But even if it's a 0.2% position halves, it's still a 0.1% loss in performance. So we still have to see whether it's a timing issue or whether we got it completely wrong. At the time, we bought the Turkish lira dollar bonds. So it is a hard currency bond, and our view was that we bought it after it's already sold off a lot, and then these additional political events happened, which just resulted in the second leg. So for us, it's now a wait-and-see approach. We're not adding to it. It's down to 0.1% of the fund. We're not going to sell it at these levels, but we just going to take the wait-and-see approach now.
Okay, I see. Sorry about that.
No, it's a
and then you also
question.
had a slide up there about the carry trade. I remember
Yes.
going back to my investment banking days in the UK, where you could borrow, Japanese yen at 10 basis points, invested pretty much in any other region,
Yes.
and you can get a positive return on that, and you're just carrying, I guess, a bit of currency risk.
Exactly.
Given that, a lot of commentators are expecting these rate hikes, particularly in the US. I think even 4 potentially rate hikes
Yes.
during the course of this year. Forecasts are maybe for the UK to have 1, maximum 2. Europe, maybe even not at all.
Yeah.
What does this bode in terms, I guess, of the dollar, or the rand for that matter? Because I know you have increased your rand sort of bond holdings as well, particularly the Govy ones. I think up
Yes.
to almost 30% in
That's
the
right.
fund.
Yeah.
But also, should this typically lead to some sort of dollar strength, and what does that mean for the rand holding up?
Yeah, typically you will find that as the US increase their interest rates, you find dollar strength. Unfortunately, they're coming from such a low base, and they're increasing at 25 basis point increments. So even if they increase, say, 6 times, it's a 1.5% increase. It's still the yield gap between us and them still remains huge and hugely attractive. That's the first thing. The second thing is we also probably going to increase interest rates despite our already high real rates. We're probably also looking to increase. So that will further keep that yield gap in place. And then thirdly, for the investor looking at that carry trade, they look at their returns in dollars, and you've seen commodity prices staying strong, which has supported the fiscal position of South Africa, which have supported our balance of trade, and which has supported the currency. So if it wasn't for that, our currency would have been significantly weaker, but it has supported the currency, and those conditions are still intact. So if I was a global investor, I mean, that must be one of the most attractive investments for me, is just to bank that carry trade, and they would have made lots of money if they did it over the last 2 years.
Yeah, fair enough. I guess also, I was listening to some comments from Larry Summers, who's ex-US Treasury. I think he's either Harvard or Yale or one of those Ivy Leagues that they tend to move into post their position there. He made some interesting comments around inflation, and even last year was saying inflation would be 4%, plus. Whereas even the Federal Reserve was saying, no, it's going to be closer to 2%. So he actually was more correct in that sense.
Yeah.
He also went back to the Nixon and the Reagan years, saying they were voted in essentially because inflation really went high during the predecessor's administration, and they went in on that ticket into the presidency.
Yeah.
So he's kind of forecasting a very disgruntled US consumer, because 2% can stomach unemployment, but inflation hits everybody.
Yes.
And on the back of that, thinks that we'll see another Trump administration. So another little political anecdote for take home for today. So we do have time for one more question, and we have had a few come through from the audience. The first one was, what is the biggest risk to your view that may catch us by surprise in 2022? I think last year maybe was outside of the virus, probably maybe Chinese regulation, but for the year ahead?
Yeah, so our biggest position remains Naspers, and I think the Chinese regulation has become a bit more volatile. The valuation has already reflected that. I mean, we've seen Tencent selling off a lot, and also on the back of that, Naspers. We think the discount is very attractive for both Naspers and Prosus, and it's very encouraging to see the CEO buying almost 170 million rands. Is it rands or dollars? I'm not sure now. But
it may well be
Prosus
dollars.
shares. So for him, 170 million is small change, but I think it's a show of confidence. So for us, that is the one risk. The other one, as I said, we've increased our holdings in bonds quite a lot. And if we do see a substantial sell-off in bonds, that could also impact the fund. But saying that, when your yield on your bond holdings is 10.5%, I mean those, and say you're running at a 7 duration, those bonds have to sell off by 1.5%, and then you only still getting a 0% return for the year. So we think there's quite a bit of a buffer built into your bond returns, and then your starting yield for the next year is then 11.5%.
Yeah.
So that is a risk. If I think back of events where that would have hurt the fund, that was the likes of a Nenegate, where you've got the finance minister that's fired, and suddenly your bond yields jump up by 2 or 3%.
Yeah.
So for me, those are two of the risks within the fund. But for our equity portfolios, we think we've got quite a few hedges. We have de-risked the fund quite a lot. So, the returns that we achieved last year, one would say, okay, well, you had to take quite a lot of risk to achieve those returns. We think we achieved it with quite a conservative positioning. It was some of our long-held positions that was a drag on performance in prior years that have come through strongly now. So our basket of investment notes, our investment into the Robafking convertible debenture, and then Naspers was a drag, but British American Tobacco has been a stable one, high dividend yield, and then now a bit of capital appreciation that's also helped returns.
Okay, excellent. The clock is screaming zero dust, Omri, but thanks so much for your time today. And I think fair to say probably one of the more popular guys in asset management. So thanks again for your time. Really appreciate it.
Thanks for your time, Dave.
Take care.
Thanks very much for the listeners.